When the topic of oil crises comes up, most people immediately think of long lines at gas stations and rapidly rising fuel prices. However, these are merely the visible consequences. The real issue is that the modern world is heavily dependent on oil. Oil is not just the fuel that powers our vehicles. It is a fundamental input for countless industries, ranging from food and pharmaceuticals to plastics, textiles, computers, and transportation. Agricultural machinery, fertilizer production, factories, trucks, ships, and airplanes all rely heavily on oil. That is why even a small change in oil prices affects not only the energy sector, but the entire economy. Transportation costs increase, production becomes more expensive, and as a result, the prices of countless products, from bread to electronics, rise. So why do oil crises occur, and why do prices increase? There is no single answer. Although wars are the most noticeable cause, production decisions, international politics, the balance between supply and demand, insufficient investment, maritime transportation, and even investor psychology all influence oil prices. At the core of the oil market lies the balance between supply and demand. As the global economy grows, factories produce more goods, transportation expands, and demand for oil increases. If production cannot meet this demand, prices begin to rise rapidly. Sometimes, even if production does not decline, a faster than expected increase in demand alone can trigger significant price increases. One of the most important causes of oil crises is geopolitical developments. Since a large portion of the world's biggest oil reserves is located in the Middle East, wars and political tensions in the region directly affect global energy markets. The most striking example of this was the 1973 oil crisis. Following the Arab-Israeli War, several Arab countries imposed an oil embargo on Western nations, reducing production and causing oil prices to multiply within just a few months. In many countries, especially the United States, people formed long lines at gas stations, and various restrictions were introduced to reduce fuel consumption. The crisis shook not only the energy market but also the global economy. Inflation rose, production costs increased, and unemployment grew. This period became a major turning point in economic history by demonstrating that high inflation and low economic growth could occur simultaneously. In response, many countries began building strategic petroleum reserves, diversifying their energy sources, and investing in more efficient technologies. Before the world had fully recovered from this crisis, the Iranian Revolution of 1979 triggered another oil shock. Disruptions in production reduced the supply of oil. However, what truly drove prices higher was not the physical shortage of oil, but people's fears about the future. As companies and governments began stockpiling oil, demand increased artificially, and expectations had a greater influence on the market than the actual facts. This is one of the defining characteristics of the oil market. Prices are determined not only by production levels, but also by expectations about the future. When people believe that oil may become scarce in the future, they buy more today, and this behavior can make the crisis even worse. Another factor influencing oil prices is the policies of producing countries. Oil exporting nations sometimes limit production in an effort to push prices higher. In this regard, the production quotas set by OPEC can lead to significant changes in global markets. At other times, the problem is not production itself, but transportation. Since most oil is transported through tankers and pipelines, the closure of major shipping routes, damage to pipelines, or armed conflicts can delay millions of barrels of oil from reaching the market. Because energy markets price in future expectations, the mere emergence of such a risk is often enough to drive prices upward. For this reason, oil crises are not caused solely by physical shortages of oil. Expectations, rumors, diplomatic tensions, and investor behavior can also trigger crises. Although the world is moving toward electric vehicles and renewable energy, heavy industry, aviation, maritime transportation, and the petrochemical sector still depend heavily on oil. Therefore, oil crises are not merely events of the past. They remain one of the most significant vulnerabilities of the global economy today. The story of oil is not only the story of an energy resource, but also a story of power, economics, politics, and human psychology. After the two major oil crises of the 1970s, many people believed that the world had learned its lesson. Governments had established strategic petroleum reserves, introduced energy conservation policies, and begun investing in alternative energy sources. However, the uncertainty inherent in the oil market never truly disappeared. That is because oil remained not only an economic commodity, but also one of the most powerful instruments of international politics. One of the clearest examples of this was the Gulf War in 1990. Even the possibility of war was enough to drive oil prices higher. This is because oil markets price not only actual events but also potential future risks. During the crisis, many countries released oil from their strategic petroleum reserves, providing additional supply to the market and partially controlling the surge in prices. Nevertheless, the global economy was significantly affected by rising energy costs. In the early 2000s, the oil market was shaken once again, this time by rapid global economic growth. The rapid industrialization of China and India, in particular, pushed energy demand to unprecedented levels. While demand continued to rise, production failed to expand at the same pace, causing oil prices to climb steadily for years until they reached $147 per barrel in 2008. This increase raised costs across numerous sectors, from gasoline and transportation to manufacturing and the airline industry. However, the global financial crisis that erupted later that same year slowed economic activity. Consumption declined, demand for oil fell, and prices that had reached record highs only months earlier dropped sharply. Once again, it became clear that the oil market is influenced not only by supply, but also by changes in demand. During this period, investments by the United States in shale oil and shale gas technologies also brought about a major transformation in the global energy market. Thanks to hydraulic fracturing and horizontal drilling techniques, reserves that had previously been considered uneconomical became commercially viable, and the United States quickly became one of the world's largest oil producers. While this development reshaped the global energy balance, it also triggered a new wave of competition among oil-producing nations. Since the revenues of oil-exporting countries depended heavily on oil prices, consumer nations generally favored lower prices, whereas producing countries preferred higher ones. As a result, the oil market remained at the center of not only economic interests, but also political negotiations. The year 2020 marked one of the most extraordinary periods in the history of oil. Because of the COVID-19 pandemic, flights were grounded, factories reduced production, and global demand for oil collapsed within a remarkably short period. Production, however, could not be reduced at the same pace. Storage facilities filled up, oil tankers were left waiting offshore, and global storage capacity reached its limits. As a result, the price of a U.S. oil futures contract briefly fell below zero. The reason was simple. Contract holders had nowhere to store the oil they were obligated to take delivery of. This unprecedented event demonstrated to the entire world just how complex and fragile the oil market truly is. As economies reopened after the pandemic, demand rebounded rapidly, but production and logistics failed to recover at the same speed. Refineries struggled to return to full capacity, and oil prices began rising once again. Then in 2022, the Russia-Ukraine war triggered another major crisis in global energy markets. Because Russia is one of the world's largest energy exporters, sanctions and supply disruptions affected not only the oil market but also the natural gas market. Energy costs rose sharply, particularly across Europe, industrial production slowed, and the increase in energy prices quickly spread to food prices. This is the most dangerous aspect of oil crises. Their effects spread throughout the economy like falling dominoes. First, energy costs rise, then transportation and production become more expensive, driving inflation higher. As a result, central banks raise interest rates, investment slows, and economic growth may weaken. Moreover, oil prices are shaped not only by physical supply and demand, but also by the expectations of financial investors. Even the belief that prices will rise in the future can trigger significant movements in the market. So, could new oil crises occur? Most likely, yes. Although the world is moving toward renewable energy, oil remains indispensable in sectors such as transportation, aviation, maritime shipping, petrochemicals, and heavy industry. For this reason, developments in the oil market will continue to influence the global economy in the years ahead. Ultimately, oil crises affect far more than just the energy sector. They are global events that influence trade, inflation, central bank policies, and the daily lives of millions of people. What makes oil so important is that it remains one of the most critical elements determining how the modern world functions.